Welcome to the world of Mark's Money Mind, coming to you again from Longmont, Colorado. I'm your host, Mark Troutman. This educational and personal finance show combines money lessons, timely topics, personal stories, and community wisdom to help listeners and viewers master their finances to enjoy a stress-free life of financial freedom. Well, this is part 2 of the Financial Literacy Miniseries. In part 1, in the last episode number 55, I discussed tracking income and expenses using a money journal, which is effectively the income statement for personal finance. Hopefully you've all found a way to track your finances that suits you, whether it's a simple notebook or a spreadsheet or an app like the one I mentioned in the last episode. In this episode, part 2, I will be going over part of the net worth statement, the asset side of the net worth statement, the left-hand side of the ledger. And in part 3 next time, I will cover the liability side of the net worth statement and the calculation of net worth itself. So let's dive right in. Okay, so let's just do a quick little recap of the money journal. It was inflows or income minus expenses and also a category for savings. And savings, the net amount of your income minus expenses, or as I like to think of it, paying yourself first, putting savings first as a priority, and then living on the difference. Those savings will be converted into assets. So that's what we're going to talk about today. So the money journal, as you recall, is a period of time. It's a report over a period of time, typically monthly, quarterly, or annually. The net worth statement is a snapshot in time. It's a specific point in time. So you'll see it referred to as the net worth statement as of 12/31/2025, for example, and that would be something that we will be doing towards the end of this year. Or maybe you did one at the end of the third quarter, so it's the net worth statement as of September 30th, 2025. So you're taking a snapshot of where you stand at a specific point in time. So you're looking at different statements that you may have, and you're putting them all on one piece of paper. So let's talk about how you would organize all of those assets in your net worth statement. I like to think of it in 3 separate sections. The first section being cash and cash equivalents, and we'll get into what all of those are in a moment. The second section would be investments. And the third section would be use assets. So let's talk about each one of these categories, and then we'll come back and kind of sum it up at the end. So the first section, cash and cash equivalents, as you might imagine, could truly just be cash in a coin jar, cash laying around your house in your wallet. For the most part, it's going to be money that is in a checking or savings account, or if you had CDs, certificates of deposit, or if you had an online savings account, or if you had a money market account, anything that can be converted into cash readily. So that is going to be things, like I said, primarily for most people, it's going to be checking accounts and savings accounts. And the easiest way to get that information for your net worth statement is to just download your month-end statement for the month or the date that you're looking to create this net worth statement. So let's just use September 30th, for example. So I would download my September 30th statement for my checking account, my savings account, and I would just put those numbers right there next to checking X dollars, savings X dollars. If I had an online savings account, I would do the same thing. So you're looking up the value of those accounts as of the date of the net worth statement. Pretty simple. And then I would total them up, so you know what your total cash and cash equivalents are. The next section is investments, and those would be things like maybe savings bonds. They're not as popular these days, but maybe you have some savings bonds. You might have various types of investment accounts. You could have a regular brokerage account. You could have individual stocks and bonds potentially in that brokerage account, or mutual funds in that brokerage account. You could have an individual retirement account. We'll talk a little bit about those. It could be a Roth IRA, a traditional IRA. You could have a retirement account through work, which might be a 401k or a 403b or a 457. There are various types of retirement accounts that you might have through work. Those would all be investments. They could also be things like maybe you have investment property, you own a rental property, or maybe you are a business owner. So it's the value of your business. And again, these would all be as of the date that you've specified on your net worth statement. So just carrying our thought process forward, we were talking about September 30th. So you would find those investment account statements for that date, and you would list them down individually. For the value of a business, maybe the business itself has its own books and records, and you could have the owner's equity of it. If it's real estate, likely you could do it in two different ways. You could just do the value of that real estate business, or you could separate it into the assets and the liabilities associated with that business. And we'll talk a little bit about how that works when it comes to a primary residence, for instance. So the third category is use assets. And those are things that have value. They could be liquidated for cash, right? You could sell them. So they have a value and they should be on your net worth statement. But the primary purpose of those assets is the utilization of it. So things like a house. Now, some people will say, oh, my house is an investment. To some extent it is, but the primary purpose of owning your home is really the ability to live in it. So it's the utilization of it as shelter. And then other things that could be use assets might be vehicles, so your car. If you have a boat or RV, that would be a use asset. Any personal property. Some people will look at it from the standpoint of, instead of listing every single little item like this bicycle and that piece of furniture, you're just going to use kind of a guesstimate as to the value of these other use assets other than big ones like a car or a house. And you may just have a general category for personal property, or you can even just skip it if you want, because you're unlikely to sell those assets. But if you had some specific assets that had a significant value and they were use assets, you would list them there potentially individually or collectively under personal property. So let's go back to investments a little bit, because a lot of people want to learn more about how investments work, different types of accounts and things like that. So let's talk a little bit about that. So let's back up to cash and cash equivalents as well first. Cash and cash equivalents, like I said, they could be a checking account, a savings account, but let's talk a little bit about savings accounts, for example, or certificates of deposit or money market accounts. Typically, these are going to be, including checking accounts, FDIC insured. Each account typically is going to be insured up to $250,000. So effectively, this is a safe place to put money. You're not going to earn a lot of interest on it, especially if it's at, let's say, a brick and mortar bank, a local bank that you can walk into. They're typically not going to pay you very much interest, if anything, on checking and savings accounts. On certificates of deposit, they may pay you a little bit of interest. And that's where a lot of people will use online savings accounts, because typically they will offer much higher rates, not significant rates, but something closer to the rate of inflation. Because what happens is, in cash accounts, savings accounts, checking accounts, things like that, over time, the value of those dollars in essence becomes less as a result of inflation. And inflation is basically the price of goods goes up usually over time, and that is the rate of inflation. And so therefore, your purchasing power of those dollars that are sitting in checking and savings accounts goes down over time. It's a great place to have things like a savings account for your emergency fund because you want access to that money whenever you need it. Its intention is not necessarily to make a lot of money, but it's to be there when you need it. And effectively, what you're doing with any of these accounts is you're, in essence, lending money to the institution that's holding it for you, the bank, let's say. You're depositing what is referred to as principal, and you're earning interest. Usually that interest is credited monthly, or in the case of certificates of deposit, sometimes semi-annually. And these would be for goals of less than 3 years, or just the need to have an account to pay your bills on a monthly basis. But it's not going to necessarily keep up with inflation. To give you some perspective, over the last 50 years, from 1975 through 2024, inflation has averaged around 3.7%. If you were to walk into your bank and put money into a savings account, you may, like I said, earn zero. So effectively, you're losing to inflation every month and every year. If you were to open an online savings account, you might earn close to that rate of inflation, around 3.5% or something in that neighborhood. So you might kind of keep pace with inflation, but you're not going to make a lot of money there. So you don't want to put all of your assets in cash and cash equivalents, or as they say, under the mattress. To give you some perspective on what cash has paid over history, you can look to what are called 3-month treasury bills. So those are issued by the US government. They have a maturity of a short period of 3 months. And those have averaged around 4.3% over the last 50 years. So effectively just keeping pace with inflation. Then if you move down kind of the risk return spectrum, I guess you would say, a little bit more risky, but a little bit higher return, would be bonds. Bonds are still effectively a loan. You're lending money to whomever is issuing the bond. So like I said, they could be U.S. savings bonds. They could be government bonds, so U.S. Treasury bonds and notes. They could be corporate bonds, so lending money to a corporation, for example. They can be short-term. They can be long-term. They could be domestic, so U.S. They could be international. There's all different flavors. And the bonds themselves are priced at what is called par value, or $1,000. You would buy them if you were buying a bond directly, and most people don't, and I'll explain that in a moment. But if you were to buy them directly, typically you're going to purchase them in $1,000 increments. They will typically pay interest twice a year, semi-annually, and they have a maturity date. So in other words, it might be a 5-year bond. So it will mature in 5 years. You earn interest and it's paid out semi-annually. And at the end of the 5 years, you get your $1,000 back. It doesn't mean they're not liquid. You can sell them prior to the maturity date, but you will be selling them to somebody else as opposed to redeeming them with the organization that issued them. And the price will not necessarily be that par value. You would potentially be able to sell them for more or less depending on the prevailing interest rate environment. I won't get too deep into that, but just be aware that they are liquid. You can sell them, but you can't cash them in for their face value, let's say. And these would be used for goals that are typically like 3 years or more, or you could associate a 5-year treasury with a 5-year goal and say, I need this money in 5 years. I'll buy a bond that matures when I need the money. And that's another way to do it. To give you some perspective on the returns of bonds, so over the last same 50 years, 1975 to 2024, 10-year U.S. Treasury bonds have returned on average around 6.1%, and intermediate term corporate bonds have returned about 8.6%. And you may ask, well, why would corporate bonds pay more than U.S. Treasury bonds? Well, U.S. Treasury bonds are considered to be some of the safest bonds out there because the government can print money and pay those back. And corporate bonds, you're subject to the credit worthiness of those companies. So a company could go out of business, for example. So you should be paid more in a corporate bond than you would be in a US government bond, for example. But if you look at those rates, 6.1% for 10-year US Treasury bonds and 8.6% for intermediate term corporate bonds, that's a lot higher than inflation, right? It's about twice inflation almost. So you're getting paid to take on this kind of extra risk in the terms of volatility of the price moving around if interest rates move, and also the fact that you're kind of locking your money up for a period of time, but you're getting a net return over inflation. Historically, again, not every single year, but on an average basis, there is a net positive return relative to inflation. And again, you're a lender in this case. You're loaning money and you're receiving it back after a stated term. Most people will buy bonds not directly, but through what are called mutual funds. So a mutual fund is basically you are purchasing a fund that is offered by a provider, such as a big organization like Fidelity or Vanguard or Charles Schwab or what have you. And they are collecting the money for all of the owners of that mutual fund and buying many bonds in a bond mutual fund. And those will typically pay interest on a monthly basis. So you're diversifying your risk across many bonds. You're also not required to even pay as the $1,000. Many of them will have lower requirements to purchase the fund itself, below the $1,000, for example, and yet you're instantaneously diversified with that whatever purchase amount of that fund that you buy. So a lot of people will buy bonds through funds and not individually. Then the third one is stocks. So now you're not lending money to an issuer. You are actually an owner. You are effectively a small owner of a piece of that company that is issuing the stock. You are now a shareholder. You own a piece of the company, which effectively means that you own a piece of that company's assets and its earnings, or your share of those earnings. And stocks come in many, many flavors. There are large stocks, there are small stocks, there are companies that are very mature, there are companies that are very new, there are companies obviously in the United States and around the world. And again, many people will buy stocks not directly, although many people do, and it's a little bit more risky to buy individual stocks, but a lot of people will buy them through a mutual fund or an index fund even, and we can talk a little bit about that. And what you're doing is you're investing capital. You may earn dividends on a stock. Not all stocks pay dividends, but many do. And those dividends are usually paid out quarterly. And your rate of return is based on the change in the share price from the time you purchase it to the time you potentially sell it, and including any of the dividends that you received in the interim. And again, most people will buy stocks through mutual funds as opposed to directly, but that's effectively what you're doing. You are an owner of a public company or a collection of public companies. Now, stocks have a lot more volatility than bonds and certainly cash. However, they have historically provided higher returns. So stocks are usually used for goals that are longer in nature, goals that are 5 years or more, because of the risk of stocks going down in the short term. However, over the long term, like I said, returns have historically been higher. To give you some context, the S&P 500, which is the 500 largest companies in the United States, that index has returned approximately 12.3% over the last 50 years. And again, that's relative to inflation of 3.7%. So you can see that's about 3 times what inflation is. So historically, stocks have provided a much higher rate of return than bonds and cash. So that's why people use them for long-term goals like retirement. And if you can compound at a rate much higher than inflation, you have the opportunity to grow your wealth over an extended period of time. So let's jump to the use assets a little bit. Like I said, you would have houses or a house, your vehicles, personal property, things of that nature. And what you're going to do is you're going to list them under the use assets on your asset portion of your net worth statement. And you need to figure out what the value is. And I like to think of it as the liquidation value as of the date of your net worth statement. It's not going to be an exact number like it would be for your investments, which is pretty easy to find on your statements. You could look at Zillow for housing values. You could look at Edmunds.com for vehicle values. And I like to use what I think would be the realistic value if I had to sell the house or the vehicle in a reasonable amount of time. And then the other thing that you would also list, like I said, under investments might be your rental properties. Again, you could use Zillow to figure those out. If you have rental properties, or your business, if you're a small business owner, again, you might be able to look at the books of the business and see what it is. And then also, if you own a home and you have a mortgage, you're not going to put the net number down. You're going to put the actual value of the house in its entirety under assets. And then next time when we talk about liabilities, that's where you would put the mortgage. You would put the mortgage amount owed as of that same date of the net worth statement over on the liability side. Now, one of the common factors under the use assets is that many of these assets depreciate in value. Cars go down in value over time. Boats go down in value over time. Houses, a lot of people will say, oh, my house always goes up in value. Actually, the house itself typically goes down in value, but the land underneath holds its value or sometimes goes up in value. So net housing prices, because they include both the house itself and the land underneath it, typically across the country will increase by approximately the rate of inflation. So you're just kind of treading water. Now, again, there will be areas of the country that do much better or much worse than others. So it is a local situation as to whether your house is going to go up a lot in value or down in value. But again, it should be viewed mostly for its purpose of providing shelter. I do want to add just one little piece on different kinds of investment accounts. We talked about the investments themselves, what might be inside those accounts, but there are really three main categories of accounts. There are taxable accounts, there are tax-deferred accounts, and effectively tax-free accounts. So let's just briefly talk about what those are. Your taxable account would be certainly your checking and savings account. If you had an investment account, that would be termed a standard brokerage account. You don't get any tax deductions for any contributions you make to them. Any money that is earned in those accounts, whether it's interest or dividends or capital gains, is taxed as it's incurred along the way. Then the other type of account, which you might have like a 401k or a 403b or an individual retirement account, they come in two different flavors, traditional and Roth. So the traditional is the tax-deferred type of account, which basically means you get a tax deduction on the way in. All of the earnings inside that account, as long as it stays in the account, is tax deferred, meaning you don't pay any taxes as long as it remains in the account. However, upon withdrawal, those dollars that come out are fully taxed. It's considered a tax deferred account. And there are specific penalties if you withdraw money before age 59 and a half. There are some exceptions to that. And then that would be the same in a traditional 401k, a traditional 403b, things like that. Now, if you're in an employer plan, frequently there's going to be some kind of matching. So you put some money in and your employer might match it. So you definitely want to be on the lookout for that. You want to take full advantage of that. Also, both individual retirement accounts, otherwise referred to as IRAs, and qualified retirement accounts like 401ks and 403bs come in Roth flavor, which is tax-free. So you don't get any tax deduction on the contributions. And actually, when you pull the money out, provided that you meet certain requirements, like waiting until you're 59 and a half, you will not pay any tax or penalty on those withdrawals. There are some rules around that. I'm not going to get into all the rules, but those are some of the things. So they're really meant for retirement purposes. But the interesting thing about Roth IRAs is that you can make a withdrawal of your contributions at any time tax-free because you've already paid the taxes on it, but only the contributions, not any earnings that are in the account. There's all kinds of rules around Roth IRAs, but they're really advantageous. And we'll talk about how beneficial they can be, especially in the compounding section. So I want to kind of stop here because I'm trying to keep these pretty short and to the point so that they can be easily digestible. And hopefully you have found this helpful. We went through the asset side of the net worth statement on this episode. We will pick up again on the next episode with the rest of the net worth statement. That's liabilities and then calculating net worth. But again, just a quick summary of the net worth statement. It's assets on the left-hand side, liabilities on the right-hand side. The difference between assets and liabilities is net worth. That's the balancing mechanism for the two sides of the net worth statement. So assets equal liabilities plus net worth. You can change that equation around to assets minus liabilities equals net worth, or you can think of it as what you own minus what you owe is what your net worth is. And I will leave it at there. I hope you're enjoying this little mini-series, and we will pick up again next time with liabilities and net worth on the net worth statement. Thank you for listening to this week's show. Please click follow on your favorite podcast player or subscribe on YouTube to ensure you don't miss any future episodes. Also, please leave a rating and review for the show. This helps improve the ranking and enables other like-minded people find the content in their podcast players. I would also appreciate it if you would recommend this show to friends and family that might benefit from this content. See you next time on the Mark's Money Mind Show. Until then, make some, save and invest, live on the rest. And now for that all-important disclaimer. This show is for education and entertainment purposes only and should not be considered investment, tax, or legal advice. Please consult the appropriate advisor or advisors before implementing anything you hear on this show or any other show for that matter. While I fully intend for everything on this show to be true and accurate at the time of each recording, occasionally errors may occur. So please do your own due diligence on anything discussed.